Understanding the Federal Reserve's policy is key to beating the market and having tremendous returns in the stock market nowadays. Right now, with the Federal Reserve injecting so much liquidity into the market, a change of its policy might immediately change the state of the market. So, it is really important for investors to understand what will the Fed do next, especially two things. When will the Fed stop its monthly $120 billion worth of bond purchasing, aka tapering, and when will they decide to raise interest rates? A lot of people think tapering would reduce liquidity in the market and the stock price would fall. But that's not the case with what happened last Wednesday. After the Fed stated its projection that it will start tapering in November, the market actually went up, with the S&P 500 going up by more than 1%. But as soon as Powell started his Q&A session, the market immediately began to drop. What did he say that caused the sudden drop? On the surface, it seems like he was just restating what he has been saying for months, that inflation is transitionary and the Fed is planning to taper in November. But you have to read between the lines to really understand what Powell is hinting at. So what did the market know about the Fed's plan that regular retail investors like us don't? Well, in this video, we'll help you read between the lines and break down the implied meaning of what the Fed thinks about the market right now. There is more than you think. By listening to what Powell said after the FOMC meeting, something surprising is revealed. The Fed wants to taper starting November this year, which is what the market actually wants because of the rising inflation concerns. The market went up when the FOMC meeting notes confirmed the date. But as soon as Powell mentioned that the Fed will finish tapering in 8 months, the market began to drop again. In the past, the Fed normally finished the tapering process in 12 months, which is what people were expecting, but the Fed wants to speed it up this time. So why does the Fed want to taper so fast? We can find the answer from one of the reporter's questions. A reporter asked Powell if he will raise the interest rate before finishing tapering. The question was answered with a quick and definitive no. So, Powell is saying that the Fed will not raise interest rate before mid-2022 after they finish tapering. After all, this makes sense. By doing bond purchasing and raising interest rate at the same time, you are effectively contradicting yourself. The effects of two actions will cancel each other out. There has been a growing eagerness for the Fed to start raising interest rates because inflation is going up faster than expected. The Federal Reserve still believes that the surge in inflation is transitory. It's mainly caused by supply chain bottlenecks, which will begin to ease off in upcoming months. But it seems the officials are becoming less confident in that. We can see this from the change in dot plot. Just last March, a majority of officials didn't see a rate hike happening until 2024. But now the latest plot shows that half of Fed officials think rates will start rising by late 2022. So what changed in just 6 months? It's not because the economic outlook is stronger after a very disappointing August job report. In fact, in terms of economic outlook, officials are now anticipating a slower growth than originally expected. So the only factor left is inflation. Just listen to what Powell said in the press conference.
Inflation is elevated and will likely remain so in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly because supply bottlenecks in some sectors have limited how quickly production can respond in the near term. These bottleneck effects have been larger and longer lasting than anticipated, leading to upward revisions to participants' inflation projections for this year.
Last September, the core inflation number that the Fed uses, which excludes food and energy prices, was projected to be 1.8% in 2022. Now, that number has been nudged up to 2.3%. A 2.3% inflation isn't that bad if you think about it. The Fed has publicly said that it is willing to let inflation run above 2% to compensate for the many years it ran below that threshold. But what if the forecast is wrong? And what if inflation becomes way higher than 2.3%, like 3 or 4%? After all, the Fed is placing a big bet that inflation is only transitionary, and it will fall back to the 2% threshold. But next year, if the Federal Reserve's forecast proves wrong and inflation stays above 2% for a long time, it would be too late for them to be able to do anything. They can't raise rates to slow down inflation anymore. That's like stepping on the brake when your car is running at 200 miles per hour. A sudden stop like that would crush the economy completely. So, the Federal Reserve understands this, which is why they want to start raising interest rates earlier than later. So why don't they start doing so? What is holding them back? You see, this is the secret that Powell cannot publicly say to the press. And it doesn't have anything to do with the Federal Reserve, but with the US Treasury Department. By now, you have probably heard the term debt ceiling. and the US government is facing a potential shutdown this upcoming Friday. But what does that have to do with the Federal Reserve? Well, the US government routinely spends more money than it collects in revenue, and the shortfalls are called deficits. To cover these deficits, the Treasury Department borrows money by issuing new debt in the form of government securities. This debt is like a loan. Investors trade cash for a promise that the government will pay them back with interest. That loan is added to the total national debt. Congress has imposed a limit on the amount that the Treasury can borrow, known as the debt ceiling. Once the debt ceiling is reached, new debt cannot be issued until lawmakers vote to raise or suspend the borrowing limit. While the Treasury has some cash reserves to pay for government spending, those will eventually run out, making it unable to pay the government's bills on time and causing a government shutdown. Even worse, a government shutdown increases the risk of having a potential default on US Treasury bonds. This situation happened in 2011. When Congress came close to not extending the ceiling in 2011, S&P reduced the United States credit rating from AAA to AA. This lowered credit rating increased the Treasury's borrowing costs about $1.3 billion in the fiscal year. To avoid a potential default, the budget ceiling has to be suspended to allow the Treasury to raise money by issuing more debt. But there is one more issue. Typically, countries like China, Japan, and Germany are the largest US Treasury buyers, but with China's Evergrande situation creating a lot of uncertainty in Asia right now, there's a chance that there might not be as much buying power for the US Treasury. This decrease in buying power would cause yields on Treasury securities to go up, which would not only increase the US government cost of borrowing, but also affect a lot of businesses which have loan rates tied up with Treasury yields. So, to prevent such a situation from happening, the Fed might have to start buying Treasury bonds in the open market, which in turn affects the Fed's tapering schedule. In other words, the Fed is caught up in a dilemma. On one side, you have rising inflation concerns, which requires the Federal Reserve to start tapering and raising interest rates soon. And on the other hand, the Federal Reserve needs to work closely with the Treasury Department to pay for the massive government spending to prevent a potential default from happening. The best solution for this whole situation is for the economy to start doing better and the employment rate to start going up. As a result, it will turn over a lot of pressure on the government, providing checks to support individuals and businesses. With all that said, thank you all for watching this video. Your support is really appreciated and motivates me to provide better videos for you in the future. Please leave a comment below letting me know what you think. And as always, I'll see you in the next one.